Okay, so welcome everyone to this webinar of the French American Chamber of Commerce. The webinar is titled Emotionality and Investing. And I'm pleased to see today that there are members of the Chamber and non-members who are registered in a variety of sectors. I can see professionals from the legal sector, from accounting, from finance and more. For this very pertinent subject today. So we're going to start with Jeff de Valdivia shortly, but before I would like to give a little bit of housekeeping instructions. In terms of the webinar, it's going to last from 1 p.m. to 1:30 p.m. And then from 1:30 to 1:45, there will be questions and answers. And during the presentation by Jeff de Valdivia, you will have the opportunity to enter questions on the little questions window that you can see to the right of your screen. And we will answer, Jeff will answer the questions during the Q&A session. So we're going to start today. I'm going to introduce Jeff de Valdivia shortly. Okay, so Jeff de Valdivia is a certified financial analyst and a certified financial planner. He's an independent investment advisor for Fleurus. Jeff founded the Fleurus Investment Advisory the beginning of 2014 after more than 25 years in banking and investment management. What is also unique about Jeff is that he is an independent and a fee-only registered investment manager, so he does not receive commissions from the financial products to which he receives by his clients. So Jeff provides comprehensive and personalized financial planning and investment management services to individuals, but also to foundations. Jeff, for example, advised a large American university with, I think, close to $1 billion in assets in the management of their reserves. So as a fee-only advisor and fiduciary, Jeff works in complete alignment with interest with his clients. And as I mentioned, he was awarded the Chartered Financial Analyst designation and also the Certified Financial Planner designation. He's a native French speaker, so today the presentation will be in English. So without further ado, I will let Jeff start this presentation very timely, I must say.
Thank you very much, Jeremy, for this kind introduction. We're going to talk about the subject of emotionality and how it affects our investment decisions. And before I get into the matter itself, I should give you a little bit of information as to why I got into this subject. A few years ago, as I was managing or helping manage the endowment at the University of Wisconsin, I was privileged to attend a very high-level conference in the field of investment management. And at that conference, several behavioral finance specialists came to present their latest research. And I was fascinated by what I heard and the various behavioral biases that affect most of us. But what left me a little bit wanting was the lack of actionable decisions that could be made and practical advice that could be derived from all this research. And that got me thinking about ways to mitigate the effects of some of those behavioral biases. So without further discussion on why I came to this subject, let me start the presentation by reminding you about that phrase from a quote from Jack Bogle, the founder of Vanguard Group, that the two greatest enemies of investors in the long run are costs, expenses, and emotions. He did a great contribution to the investment world and to private investors in creating the Vanguard Group, which is really on the vanguard, literally, of cost reduction in the industry. And it served the investment population extremely well in that regard. When it comes to emotions, Jack Bogle couldn't do anything much other than control himself and his troops, because this is a very private matter. We're all different, and therefore it's very hard to give emotional advice or strategies on how to handle emotions if you don't know the person. So this is the work that we have to do on ourselves. And the way we'd like to go about this presentation is first to discuss or present a tool that behavioral psychologists use to better understand their clients who struggle with their emotion. This tool is called the emotional map. I'll present you a simplified version of the emotional map, but I think it will be very useful in understanding how we can use some of those concepts of the emotional map to mitigate the effect of very well-known behavioral biases. And my hope at the end of this presentation is that you get a better insight into your own personal makeup, and as a result, become better investors in the process. So again, this is an emotional map that is a simplified version of what really behavioral therapists use, but I think it gets the job done. On box one, top left, you've got us, each one of us, and I filled it with information relating to investment matters, but you can, fill it depending on the issues you're trying to deal with, fill it differently. But basically, the interaction between box one and box two, who we are on the left, and event, whatever that event is, of a personal nature, or in our case, in the world of investments, of an investment nature, the interaction of those two blocks generates an emotional response in the lower part section of the diagram, which is in box 3. And obviously, the emotional response will vary in its intensity based on the nature of the event, but also on the sensitivities that are our own, our understanding of the event, our professional expertise, if this is happening in a field that we know something about, but also our personal inclinations. Our fear response in the realm of investments is particularly relevant. Our tendency to fight, flee, or freeze in the face of fear. All this will color our investment response and the intensity of that response. Now, one thing that is true for all of us, irrespective of our nature, is that we tend to respond much more strongly to negative news than we do to positive news, and by a factor of about 5. So all things equal otherwise, bad news is going to hit us 5 times as much as good news will. And that creates a real issue in the context of investment management. How can you recalibrate the size of that box number 3 if the news is negative, and achieve basically this emotional map, the following one, this one, where the size of the negative response box is almost reduced to that of the positive. That's an ideal situation that we should all strive for. How do we go about it? Well, let me propose the following set of actions. The first thing to do, and we know that from personal experience, not only in investment, but in many situations where we have encountered exciting or painful events. You try to stretch the time and space between the event that triggers the emotional response and the response itself, the behavior, the actions you are going to take. It is very important to stretch that time and space as much as you can. This is the breathing that we do when somebody is really behaving unpleasantly to us, or this is the walking I used to do, apparently not enough. When I was receiving in the corporate world a memo or an email that I didn't like, I went out, walked around the block, and didn't answer to those emails for 45 minutes. This is a very, very useful tool. We try to stretch. The other thing that you do, or that I suggest you do in those events, is analyze the event itself in box number 2. And of course, you come to it with your own expertise, your own biases and everything else. But the simple fact that you're taking the time to look at the problem, to focus on it, to name it, that simple fact is going to most likely reduce the amount of stress and emotionality in and of itself, whether you resolve the problem or think you're on, think you're on your way to resolving it. The simple process of going through an analysis or attempting the analysis is going to reduce the level of intensity and therefore lead you to potentially better behavior, better action. And in the longer run, really what we all need to do is to work on box number 1, which is our own personal makeup from an emotional standpoint as well as from a professional standpoint. So in the case of investing, for me, it's constant research in the field so that I can better analyze events as they come. But it's also work on myself from an emotional standpoint in understanding what my natural biases are and developing ways to mitigate them. So we're going to look at 3 behavioral biases that are fairly common to most investors and see how we can use that emotional map and that approach, those three suggestions that I made, to reduce their potential negative impact on portfolio management. So the recency bias is the tendency to outweigh recent events and to basically react to news, new information, a little too much. And that's really the tendency that we share with a vast part of the population. And that's a tendency and a bias that television, radio hosts use and reuse as much as they can to push us to an emotional response. And this is what we have to deal with when the bad news come on the investment front. The other one we're going to look at is the conservatism bias, which is the other side of that same coin. Instead of overreacting or reacting too often to news, we fail to integrate relevant information in our thinking and do nothing. It's an interesting situation also that affects some of us. And finally, I will touch on the overconfidence bias, which is the tendency that most of us have to feel that we're above average in almost everything we do. Maybe I talk for myself, but that's my tendency. And I have to think long and hard about how to mitigate that bias, because it can have serious effects on investment management decisions. So let's look at the recency bias in more detail. So this is a chart of the S&P 500, the U.S. equity index, over the past 6 months. And the vertical line that you see almost in the middle of the screen here on that chart marks the beginning of that descent of 20% that the index had from October 2nd, 2018, so the last quarter, to the bottom that you see, and that was reached on December 24th, 2018. So we had 3 months of fairly painful degradation in the equities market. And I would argue that I would guess, not argue, but guess that many investors ended up making significant mistakes during that period of time, because a 20% drop, even if it's not continuous like this, we have reprieve in the middle where you see those 2 bumps in November. This is a painful situation to go through. So let's try to apply the emotional map or the 3 suggestions I mentioned: the stretching, the analysis. Let's start with the analysis. On the assumption that you are not reacting immediately as the market drops, the first really drop before we see that camel hump, the first drop was in October, and that really reached about 8-9%, about half of the drop. So on the assumption that you are not reacting immediately and selling or reducing your position immediately, you've got to go into analysis mode. And the analysis would have brought the following, a rational analysis. This whole move was triggered on October 2nd by an announcement by Chairman Powell, the chairman of the Federal Reserve Bank, that they were more likely than not going to raise interest rates in early December at their next meeting. So that was factual. That was an announcement, and there was legitimate reason for dropping a few percentage points there. The reason why, however, we accelerated in October down to 10% was a fear by a lot of people in the market that the third quarter corporate earnings were not going to be very good. That was a fear. That was not realized at all. And it's not realized, and we see that in the behavior of the market in November. The market goes up, down, up again. The market is finding its footing in November because corporate earnings have not been that disappointing. And the fears of a slowdown, global economic slowdown, are not yet confirmed. Now, the reason why we have that last drop of 10% in December is that the Fed does act on its word. So we knew that. There was nothing new there. What we didn't know is that the Trump administration was going to attack the Federal Reserve, which tended, in my view, but I think in the view of a lot of people, professionals in the business, is not a good thing, institutionally speaking. So that started a movement down that was accelerated in part by soft economic news coming from China. But you need many data points to confirm a slowdown in the economy. This was just one data point. And then we have another acceleration at the very end of December that is associated with unexpected resignation of Defense Secretary Mattis. So when you put all this together, you have an acceleration of the drop of 20%. The two facts are only the Fed deciding to hike rates and the decision by Secretary of Defense Mattis to leave. But that's a transitory fact, I would argue. That is not fundamental to the market. That doesn't justify that this market would stay down that much. So a cool analysis, I would argue, would have questioned the intensity of that drop on the downside and therefore prevented heavy selling, at least as far as I'm concerned. So an analysis, a serious analysis of the situation would have generally prevented significant reduction of risk in that market. But that doesn't mean it would have been easy to do. It's very difficult to do, and you need to be equipped to do it or feel you are equipped to do it. But and the ability to discern between transitory events and lasting events like a Fed move is a lasting event. All the others were not confirmed, and actually in January they were reversed. The news from China got better. Corporate earnings certainly were not bad in the third quarter, and we had better earnings released recently. So you know the story. We're back to where we were. So that's the difficulty in handling the recency effect. The ability to analyze it, the ability to stretch the time you give yourself to respond. Very, very important. We can go now to an illustration of what I thought was the conservatism bias. Here you have a chart of General Electric, the stock, the equity of General Electric over the past 25 years. On the left of that chart, you have the rise from about $50 in 1996 to about 170 in March 2000 at the top of the market before the tech bubble burst. Such a rise, at the time of irrational exuberance, as Alan Greenspan, ex-Fed chair, used to say, was not unexpected. Markets were going 25% up every year at the end of the 90s. What was a little bit surprising in the case of General Electric is that it was a manufacturing stock and behaving like a tech stock. So that should have given pause to anyone. But at the time, the messiah of the corporate world, Jack Welch, was in charge, and this gentleman couldn't do anything wrong. So when you have an exuberant market plus a charismatic leader, you can sometimes get to type of propulsion that this stock enjoyed. Inevitably, it went down. It went down and crashed just like any other stock. I would argue more than any other manufacturing stock. It lost 3/4 of its value. That said, why do I use this to illustrate the conservatism bias? I do because when you've enjoyed a ride that takes you from 50 to 170, even if you drop to 50, again, you still think that this stock is going to come back. And what do you do to, or some may think that anyway, and what do you do to fight this? Well, you analyze the data. The reality is that after March 2000, this stock never came back to 50 again. And even if you were with it at the end of the tech recession, which lasted until 2003, an analysis of other stocks in that industry or an analysis of the behavior of that stock against the S&P 500 would have shown that it was not bouncing back to those levels. There was something seriously misaligned there. So again, that's where the analysis of the situation is vital in your ability to fight that propensity, in this case, to do nothing. Do nothing because GE is great. Well, GE wasn't that great, and the future proved it after that. So here in this situation, analysis is fundamental, but also timing is fundamental, as it always is. But in this case, you need to give yourself time and a specific time to get out or make a decision and justify your decision. And I would argue that a lot of people get caught with this bias by not imposing on themselves enough of a deadline. And the third thing that one can do, generally speaking, is to avoid that type of attachment to a given stock, is to not buy stocks, but buy ETFs, exchange traded funds, which are mutual funds on the inexpensive side. And the emotional pull will be reduced as a consequence. So for me and my clients, I rarely invest in single stock as a precaution. The next one I want to discuss a little bit with you is the overconfidence bias, which is the tendency we have to think that we're better than average and therefore not look at our investment decision too closely. And that can be also quite detrimental. The solution here is pretty simple again. It's not an issue of stretching time here. There is no event that triggers this necessarily. Here, the issue is, again, analysis. You have to analyze your decision. In order to consider yourself a good investor or above average and to deserve that confidence in yourself, you need to be right in your investment decisions about 55% of the time or more. That doesn't seem like much, but it's quite difficult to achieve. And if you really want to know whether you're good or you could be good at investment and managing your own portfolio, you have to track those decisions. And you track them by registering and tracking on an Excel spreadsheet. That's what I do. All my decisions, all your decisions, and check them 3 months, 6 months, 9 months later. See if that sell order you passed was a valid one, ended up being a positive for your portfolio or not. And if you can maintain 55% or above, yep, you're pretty good. If not, you may want to seek advice and really look at reality. This is very hard to achieve. And this is what you can achieve when you know yourself quite well from an emotional standpoint, because emotions play a part in there. And also from a professional standpoint, are you equipped technically to be able to do this? So as a recap of this presentation before we get into the questions, this is the key tool, the emotional map that we need to use. And the objective here at the bottom, again, is to recalibrate the intensity of our emotional response to negative news. And again, as a recap, I would use those 3 points. Develop a real understanding of the event itself. You know, it could be a market dropping 10, 15%, or as of the last 2 days, the market dropping 2.5, 3%. Why? Is it justified? Is it transitory? What is the probability that this will go down farther than it is currently? Second, give yourself time. Don't react on Monday or Tuesday when the market tanks 2%. There's not enough time here for you to make, generally speaking, a wise decision, unless you're a trader. But you're not an investor if you're a trader. That's a different animal, and that's not what I'm talking about. So give yourself time. Do not react immediately. Analyze the situation. And again, in the longer run, work on yourself, your emotional makeup, understand what makes you tick, what makes you react, what makes you overreact, and work on your level of understanding of those events. You know, take classes, go to seminars. That will improve your ability to react in a calibrated manner when the inevitable market downturn takes place. So this is all I had to say about the subject for now. And if you have questions, I will be very happy to answer them.
Okay, thank you, Jeff de Valdivia, for this great presentation. Very clear, very insightful, and so I want to. I'm going to start with one question that I see, but I would like also to encourage you to submit more questions. And you can use the questions window that is on the question section that is on your control panel, which is on the right side of the screen, to submit your questions. But I'm going to start right now with a question that is very timely, which is what did you, Jeff, do with your clients in the fourth quarter of 2018 when there was this big drop in the market?
Oh yeah, thank you, Jeremy. That's a very good question. If you go back to the chart of the S&P, that will help answer this question. It's the first chart, yes, this one, the recency. So when you have a 20% drop, you're emotional, and I'm not immune to that. So when the first leg, 5 to 10% drop in October took place, I looked at my portfolio and that of my clients because I'm invested along the same line, and everything was more or less in behaving properly. We were down, and down almost the way I would have expected, given the circumstance, except for one investment. One investment was underperforming, that is going south a little faster than the rest, and it was a fund that I used for U.S. equity growth allocation. So my decision was, am I going to reduce that position right away? Am I going to sell and stay out? What I decided to do was to move partially out of that fund, which was misbehaving at the time, and go into another equity fund, but a value fund. So I moved from a growth fund to a value fund to reduce the level of risk, but not to reduce the allocation to equity. So I didn't reduce my client and my personal allocation to equity, and I kept an eye on that fund. It so happens that over the next 90 days, that fund bounced back, and more than the index, and more than the NASDAQ, and only then did I reduce further that position. And again, that was the end of January. So I avoided making a significant mistake, which would have been to get rid of that fund at the time it was down, even if there was some justification to doing it because it was underperforming. It was not because it was going down with the market. It was because it was going down faster than the market. And that's the level of analysis you should have and should conduct in order to basically make better decisions overall. So I didn't sell. It was painful. I changed the color of the portfolio. I reduced the risk without really meaningfully reducing equities in the portfolio. And as a result, we were able to bounce with the market and a little more, actually, because we were at the end of March, my portfolios, the one I'm taking care of, were back up higher than at the level or generally higher than the top of the market at the end of September. So that's how I handled that situation.
Okay, thank you, Jeff, for this answer. We have a few more questions coming up. Great to see that you are very interested in this presentation. The question that we have is, what is a good amount of time to wait to provide enough time to have a logical and educated response to something like a market decline?
That's a good question, and there's no, as far as I know, there is no answer to that, really. It's obviously you avoid the immediate response. So I'll give you an anecdote. 25 years ago, I read a book written by a guru of investment management at the time, Peter Lynch, ex-Fidelity Magellan manager. And he was saying, I never buy on Monday, because on Monday, people dump stock or do things that they have been mulling over the weekend, and the market misbehave on Monday. So I never buy or sell on Monday, or rarely do. So that's take at least one day before you're going to react, all things equal otherwise. The length of time depends on the intensity of the movement, on volatility in the market, on various data points that you can use that, and based on your experience. So I really can't answer that. I think if you know what you have in your portfolio and what you have in your portfolio behaves in accordance with what is going on in the market, there is no obvious change to make. If you're invested 50% in equities, US equities, and they go down 20%, you go down 10%, well, this is what exposure is all about. You should expect that. Now, what you need to correct very quickly is a situation where you go down 12% when you should be going down 10%. That really is the correction you want to make. But if you're happy with your 50 allocation long term, there is no immediate action to take. If the downdraft continues, then you have to deal with more intensity on the emotional side, and that's where your overall asset allocation before the crisis matters a lot. You have to anticipate, not only anticipate the movement, but understand that market dropping 20-25% happened with some regularity. So before the crisis happened, like in September in this case, the question I was playing with is, the market has been doing very well for the past year and a half, 2 years. Valuations are high. What should I do now to protect customer portfolios if something happens? And they were already positioned with equity allocations that were not excessive. So all I did in September really was, again, played with the color of the fund. I moved out a little bit at the margin of growth equities and went into utilities, which are a safer sector. So my response to your question is not really satisfactory because there is no timing. It depends on the situation. But one thing is important. You have first to know what you have in your portfolio so that your level of understanding of its reaction to a market downdraft is aligned with what you see in the market. That gives you a degree of comfort If it does better on a relative basis, that gives you a greater degree of comfort, and that means you're better positioned. So you're better positioned to withstand another downdraft should it occur. I had to take pretty quick action because one key component of the portfolio was misbehaving. I hope that answers partially your question.
Thank you. Thank you, Jeff. We have another question here, which is, when you hear outrageous commentary on a daily basis from the Trump administration, do you risk falling into conservatism as you become immune to the resulting alarm bells?
That's an interesting question. So far since the election of November 2016, the market has been generally, I would argue, I haven't checked that, but I would guess, more volatile. But performance overall has been good to decent. The market, the S&P was up 21% in 2018, January to December. It was down about 4% last year. So on average, 8-9%. That's not bad. Is the administration the administration comments leading potentially to conservatism because you tune them out? It's a risk. It's a risk. In the current situation, for example, the reaction over the weekend on the China-U.S. trade issue is totally unexpected given the information we had before that everything was hunky-dory. And there is a chance that markets are tuning it out as is part of this administration behavior. There's also a chance that things could go very poorly, and that's where your question is, I believe, heading. And that's where you assess the situation, and that's what I'm trying to do right now. I'm doing nothing for now because I think the probability of China and the U.S. not reaching an agreement on Friday is still relatively low in the 20-25%. But there is a risk that we are getting immune, including investment managers, to the volatility that is caused by the Trump administration and its decisions. I think overall, most investment managers, professionals anyway, are tuning it out for good reason. So far, for good reasons. So I'm continuing to follow that line. But you're right, there is a risk of being trapped in that do nothing attitude, and that could be painful in the long run. Okay,
thank you, Jeff. And I think we're going to have time for one or two more questions. We have a question here about what is happening right now as we speak, as the markets seem to be dropping in light of the China-U.S. tensions and recent tweets by the president.
Yeah, I think I started addressing this in the previous question. What I think is happening right now is on Tuesday we had a significant reaction. We have on Monday a great negative reaction, down 1.5% for the S&P at the opening, but basically those losses were 90% erased by the end of the day. As additional information came in about the Chinese position and what may have triggered those tweets from President Trump, the situation deteriorated further. Before I came in today, I checked the market until about 12 o'clock. The market was fairly stable, starting slightly positive, and I think that's a safe response so far, which doesn't mean it's not going to go south if they don't find an agreement. I think that they will find an agreement. The probability, as I mentioned, is probably 70 to 80% that they will agree on something because both sides have a political interest in reaching an agreement. but there is a possibility that we're wrong. And if we are wrong, and if they don't find an agreement, and tariffs are imposed as Trump has threatened on Friday, we could very well see a market drop of 5 to 10% over the next 10 days. That would be a significant event. Again, I feel that the probability of that is not it's significant, but not great at the same time. I hope that provides some element of response to your question.
Okay, thank you, Jeff. And I think we're running out of time, so we're going to conclude here. I have someone also who wrote a thank you for this. Thank you for a super insightful analysis, linking psychological makeup and investing reactions. So that's a nice thank you. Thank you for your message. So we're going to conclude now. As you can see on your screen, there is the email address and even the phone number of Jeff de Valdivia. So do not hesitate to address more questions to Jeff. He'll be happy to answer, and also to visit his website. And I should also let you know that this webinar has been recorded, and that we will send a recording to everyone, and including those who registered but could not make it. We'll also post on the social media about this webinar, so feel free to share. Please follow the French American Chamber of Commerce LinkedIn page, and feel free to share this post so that your networks can have access to it. And again, thank you to everyone for attending. Thank you to our members. Thank you to our guests. Please do not hesitate, if you're not a member, to contact me about the benefits of membership in the French American Chamber of Commerce. We have great events coming up, including the French American Sustainability and Innovation Forum, which is on Monday of next week for between 12 and 8, with fantastic panelists, chief sustainability officers of Pernod Ricard, L'Oréal, Danone, the head of the United Nations Global Compact, and more stellar speakers. So I encourage you to visit our website and sign up for this event. We still have some spots available. So again, thank you to everyone, and it's a pleasure to be offering you this webinar. Thanks again a million to Jeff for this great presentation, and hoping to see you soon at another event. Thank you.